Hello and welcome to the FT's special report on the future of commodities. Joining me is Anthony Lober, the head of oil and gas at KPMG. Big oil has been in the papers as never before in the past few months on the back of the BP oil spill in the Gulf of Mexico. What are the ramifications, do you think, for the industry of the spill?
I think the industry as a whole is looking at the regulatory implications, and clearly the cost of deep water drilling is going to become more expensive. So the first, I think, difference is going to be people are going to think very carefully around deep water drilling in the Gulf of Mexico and deep water Brazil. And those areas are going to favour people with big balance sheets and the ability to have or pay for the liabilities that may occur for deep water drilling.
Right. Do you think, just on the back of that big oil is a busted model? Yes, you need to be big in order to pay for these sorts of risks. But on the stock market, the majors haven't performed that well. Total shareholder returns aren't very high. Production growth hasn't been very good over the past 5 years. Is big oil a busted model? No,
I don't think it's a busted model. And the reasons I don't think it's a busted model is because the international oil companies still have an important role to play. They will have to look for new ways for making money, and it'll be around technological advances like the Exxon XTO deal in Canada, where they'll look at the ability to take shale gas and different technologies for to drive their revenues forward. I still think they'll have to compete with the national oil companies, who will have a very strong position around their own reserves in their own domestic boundaries.
I guess the big problem for big oil is the fact that their production growth hasn't been stellar over the past 5 years. I think none of the major 5 companies have actually shown any really good growth. Is that the problem? I mean, they need to go to deeper and deeper areas like the deep waters of the Gulf of Mexico in order to get their oil. They're more expensive, they're more costly, the risks are higher.
I think that's certainly true, but I think the undertone to that is what's happening in the industry. So national oil companies are looking at taking a bigger control of their own reserves. You've got resource nationalism happening, and in certain key geographic areas like Africa and Iraq, there's a degree of political instability which makes it difficult for independent oil companies to operate in. Also, the nature of the contracts that independent oil companies are being offered has changed. If you go back in time, lots of the independent oil companies were being offered production sharing agreements, but now in a lot of territories like Iraq, what's being offered is service contracts, which means that they get a set fee as opposed to ownership of the reserves.
Right, and presumably for big oil, for the likes of BP, Exxon, Chevron, do they need to accept these new terms, given that they do need to look for more oil?
I think clearly if you look at Iraq as an example, they've clearly accepted them because the size of the prize is so great. So all of the majors are looking to get into there. But I think in certain territories like Africa, where the independent oil brings technological skills, which is what's there at their forefront, plus project management skills, then I think they're looking for production sharing agreements where they have ownership of those reserves. So I think you have to look at it on a territory by territory basis.
Well, what about, just to go back to BP again, and the performance of the majors on the stock market. Some of the investors in BP and also more generally have argued that BP should split itself into 2 types of stocks, an upstream stock, so exploration, and a downstream stock, refining and marketing. Is that viable at all? I mean, what are the sort of pros and cons of doing that?
I think if you look at the industry as a whole, particularly around the independents, most of them are embarking on a strategy around selling some of their non-profitable downstream businesses, which are basically in Western Europe, and we're seeing that as a trend. So in terms of splitting themselves up, I'm not sure I'd go that far, but I think independent oil companies are clearly reacting to where do they get the best return on their capital, and that's clearly in the upstream sector, and they're looking to divest the less profitable, higher capital downstream pieces. So I think we're seeing the industry react to that already.
Right. Should the majors be spending more on exploration then? Have they been spending enough?
I think the key issue for the independents is what's the long-term price of oil? And if you go back over the last 18 months, there's been huge volatility and a degree of uncertainty of where that price is. Independents have had a number of strains on their balance sheet. They've had the ability to pay dividends, they've had the large capital projects, and that's meant that they have to place their bets in certain places. So I think it's changed the way that they've invested in oil exploration. They've had to look at where's the best return for their investment. So that's the trend that I think I'm seeing.
Right, and presumably some of the areas that they're investing in, I mean, Shell's got a big tar sands exploration project going on in Canada. They require quite a high oil price, don't they, to be profitable, those sorts of projects?
I think a lot of the technologically advanced reserves need a higher oil price, and I think a lot of the commentators look at a price between $60 and $80. So if you go back over the last 18 months when the oil price was closer to $40 to $50, then there was a degree of uncertainty of whether to invest in those large capex projects. So now as we're seeing the oil price rise and sit within that range, a lot of the independent oil companies are reinvesting again in some of these alternative projects.
Right. And what about actual sort of partnerships or more in partnerships between the oil majors and the national oil companies? Will we see more of that?
I personally think we'll see a lot more of that. I think we've seen that with Shell and PetroChina in Australia. I think we'll continue to see the national oil companies team up with the independents where they have the technological skills and have been in certain countries for a long period of time and therefore understand both the political risk and know how to operate. So I think that's a trend that we'll only see continue. But underneath that, I think you also need to look at the service companies, the likes of Schlumberger, Halliburton, who have been partnering with the national oil companies quite a lot over the last decade. And I think that's a trend that will continue to see over the next 5 or 6 years.
Well, what about alternative forms of energy? I mean, renewables, green energy, nuclear, is that a possibility for any of the oil majors, or is that really out of the question?
I think it's constantly an area of debate. I think one of the areas that I see as a key driver or a key issue as an alternative energy is around the nuclear debate, particularly in the UK and in Europe. We've obviously seen a new wave of nuclear power stations about to be built in the future, and we need that to happen in order for our energy security. So I think nuclear is clearly going to be part of that debate. In terms of alternative energy, I think wind and tidal will continue to be on the debate for the next few years.
Right. And if I was an investor in big oil, or if I was a potential oil investor, would you advise me to invest in big oil or an oil explorer like a Can Energy that's obviously delivered for its shareholders in recent years?
I think it depends on your appetite for risk. The excitement that goes with the exploration side, where you've got that huge upside, is always attractive. So it depends on your appetite to risk.
Right. Thank you very much for joining us.
Thank you, Sylvia.